Welcome to our eSignal Weekly Forex and Futures Forecast. My name is Jay Norris. I teach trading at Trading University. As always, we need to remind you trading involves risk of loss and is not suitable for all investors. First market we'll cover will be the Australian US dollar. Aussie dollar backing down in sympathy with that strong US dollar this week. We said a couple weeks ago that we like the area just above 77 even. There it is. We've got support marked on there. So that's going to be a natural target for us. Overall, you're in a secondary move after carving out that intermediate term bottom. Secondary moves a little trickier to trade because overall they are counter trend in nature, and you see that in the fast moves here. Quick moves up, and then bam, turns right around and even faster on the way down. That's the nature of a counter trend move. Tricky to trade. Let's see if the support does hold coming up to just above the 77 even level. Next market, the dollar Swiss. Now here's a good looking market. Look, you have a nice double bottom on support in line with those higher time frame patterns. So that's going to be one worth watching. However, as you can see, I put that trend line on there. You know, that's going to be a big difference. This is definitely a level to watch, this trend line. So if you can claw your way above there in the dollar Swiss, that's definitely going to be one to watch. And you know, I think we hit it right on the head 2 weeks ago. We said this is an area on the chart you could start to buy from a dollar cost averaging perspective in here. And you know, the timing worked out pretty good on that. But the reason we like the dollar cost averaging is because you could still see lower prices. And when we say dollar cost average, you want a dollar cost average a cash position. You don't want to do that with leverage, but I definitely stand by that. I think this is a market where you want to look to start to accumulate this guy on a longer term basis. Now, on the other hand, if you take out this trend line here, you get a daily close above that trend line, or a couple daily closes above that trend line, then I think you can look to buy dips with leverage in this guy. Next market, the dollar index. Dollar index, pretty quick turnaround. You know, and again, I'm reminded that you're in a corrective environment here. You're in a counter trend environment. So so typical of that, you see that really fast hard move down, and you see the turnaround and even faster on the way up. A tricky market to trade. And you know, this chart reminds me why overall we said, hey, hang on to those long-term dollar longs. Because, boy, I tell you what, the thing about counter trend markets, they're tricky. As Charles Dow taught in Robert Ray's book, The Dow Theory, it was spelled out so clearly that the thing about counter trend moves, the thing about these secondary moves is you just never know how long they're going to last, and you never know when they're going to end, too. So that's why I think it's important that we keep our eye on the big picture here, the long-term trend in the dollar index, and that's higher. So hang on to those long-term dollars, and it's just a matter of time, we feel, until this guy works itself out on the downside and gives us some more clear direction here. Here's our RTT ratio, and this really determines how we trade this market, and I think this sums it up best. We generally trade the 5 through 25 day patterns, and we trade with the majority of those patterns. So the majority of the 5 and 25 are up, correct? So we're buying dips. On the other hand, we also trade the 10 through 50 day patterns. We trade with the majority of those patterns. Guess what? The majority of those patterns are down. So overall, we're both buying dips and selling rallies in the dollar index. So that's a two-way market. That's the epitome of a counter trend market, and that's where we're at here. So kind of hard to want to step out on either side when I know that the method we follow is both buying dips and selling rally. So more likely you'll see continued two-way trade in this guy going forward. Overall, we're still bulled up long term. You know, you could say the mirror opposite of the euro here. Here I've drawn a very, very important level for us. What's going to jump start us out of that two-way mode would be a close below this level at 108.50 or so. You get a close below 108.50, that will definitely shift that important 25-day pattern lower. And once that 25 shifts lower, that means we're nothing but selling rallies and taking sell signals. Otherwise, we'd no longer be in the dip buying camp. Currently, if you trade the 10 to 50, which we do you're still buying dips. So again, you're in a two-way trade here in the euro. The big number here is going to be 108.50 or so. You close below that, and that's going to open the door to the downside. The big picture here, from our perspective, is still lower. Parity's not that far in this market at all. So a lot of downside here overall. But back to the daily chart, shorter term, intermediate term, you still have support here in this market. And hey, the bottom line, we're in a counter trend environment. We've been in a counter trend environment, so that's a market where you trade both sides, and you're seeing the value in that too. Where again, you have that sharp move up, and then boom, turn around, even bigger move on the way down. It's tricky to trade one side, so we think you'll still be best served by trading both sides of that market. The gold market. Gold had a pretty sharp move down. We would have liked to seen a more cleaner formation in that zone. You can see he just got into the sell zone, and then it collapsed. Didn't give us much of a formation. Happened pretty quick. Tough one to, tough trade to get your teeth into, that short trade in the gold. Another market where you're looking at two-way trade. Yeah, you had a big shift earlier in the week, and you shifted that 5-day pattern down, yet you're still exhibiting a pattern here, shorter term anyway, of a higher low and potentially a higher low in here too. So gold's still hanging on. We'd really love to see a test of 1245 or so, or even now a double top. Now that you have a isolated high here, a double top at 1232 or so, that would pique our interest as far as going short the gold long term. Our analysis here will be similar to the euro, that long term you want to maintain shorts, long term you're looking at sell rallies. Intermediate term, shorter term, however, you're looking at potential two-way trade here. But I don't want to take my eye off the prize here. I think when gold breaks down here, you take out that trend line. I'd have to look at the specific levels here, but probably somewhere around 1185 or so. You take out that level, and we think there's a lot of room below in the gold. Here's the monthly chart. To me, the biggest theme, the one thing I believe pretty strongly you can count on, is going to be higher rates in the U.S. All the studying I do on that subject tells me that you see lower commodity prices, lower gold, once you see interest rates in the United States start to kick in. So we feel there's a lot of room below in the gold. Speaking of interest rates, the last chart we're going to cover will be the 10-year yield in the U.S. It broke out last month, and to me this looks like a bull flag. This is the yield in the U.S. You could see it broke above 2% here. Then it broke that long-term trend line, 2.10. To me, this looks like consolidation before another move. So you're in a pennant here. At any rate, to me that looks like consolidation. The market's sowing in support here. The market's getting comfortable for the next leg up. The next leg up in U.S. interest rates from a textbook economic perspective is going to be dollar friendly and bearish for commodities, i.e. gold. So we'll have to see. My name is Jay Norris. I teach trading at Trading University. Thank you so much, and we look forward to seeing you next week.